So the bad thing that it is reflecting, Kelly, is that the cash markets are flooded right now with crude oil. It's backing up in the system. Refiners are dialing back. So that contract you referenced, the May contract, expires on Tuesday. Some of those barrels will go to delivery. There are some people who will actually take delivery or try to make delivery against that contract into an already overly supplied system. And on top of what we have going on right now, there are concerns about storage tanks in the U.S. for crude oil filling up probably the next 8 weeks or so. And the real punch in the gut here from our good friends, the Saudis, they're sending 20 super tankers our way on top of everything else. So the cash market's a mess. There's some hopefulness in the market about the drop in the rig count and other measures that are being taken. That's why you see next month's crude oil contract and the following months much higher than the sub-18 you're seeing right now.
Yeah, and there's a huge spread between WTI and Brent right now by about $10. So maybe some of this will normalize next week. Shin, let me ask you, energy is leading the way today in terms of the stock market. Why do you think that is?
This is an incredibly important event that's happening in oil markets. That's a direct result of the coronavirus and how everything is unfolding on the demand side. We're heading into what looks like a recession very clearly. Oil demand is incredibly weak with further downside risk. As John mentioned, supply is starting to respond. Not only are we seeing rigs down, several operators are announcing major cuts to spending plans for the year. Fracking activity is down something like 40% in the last month alone. And then, of course, last week we had this all-important OPEC Plus deal. They agreed to a 9.7 million barrel a day cut. And all this is happening. It's just that it's not enough, right? Mm-hmm. We still see the need for significant curtailment. Even with the OPEC deal taking off, we estimate something like 7 million barrels a day over the next month or two. We've had about 1.5 to 2 million barrels a day in announced economic shut-ins already on economic supply. But you know what? Prices still have a lot of work to do in order to resolve the 10 to 15 million barrel a day imbalance that we see. And as storage fills up, Cushing is going to fill up in the next few weeks. We're going to need prices to take out supply.
And John, so it sounds like there's kind of no good reason for the energy stocks to be up today. Would you attribute that to anything special? And would you have kind of similarly bearish views about how much lower the price of oil is going to go?
Well, there's no. I'm in total agreement about the bearish outlook for the price of oil. But as was mentioned, the industry is responding, Kelly. In a big way. Operating crude oil rigs in this country are down. They've been basically cut in half in less than a year's time. So you're going to see the U.S. production come down, and I think the future of energy here is the big oil companies, the companies who have cash in the balance sheet that can withstand this series of body blows that the industry is taking right now. Whoever is still walking around with share and the cockroaches after this nuclear apocalypse in the energy industry, they're going to thrive and they're going to do well. And I think that's where the bets are being placed now in the equity market on some of those companies.
John, quick question here. When do we run out of storage for all this surplus oil? When do we start to have using swimming pools?
Yeah, or Joe Kernan's pool. I think about 8 weeks from now, Kyler, put it towards June, July timeframe is when you really see that. And they're also going to start to use pipelines. There's also one company is also looking into using their vast liquefied natural gas caverns for potential storage. So don't ever underestimate the ingenuity of the U.S. oil industry, but their backs are up against the wall.
Mm-hmm. All right, John Kilduff, Shin Kim, thank you both.